Welcome back to Options Trading for Beginners. In our last video, we covered the role of volatility in options trading and how a high implied volatility can lead to a phenomenon known as volatility crush. Today, we're going to put that knowledge to practical use by showing you exactly how to read an options chain. The options chain is the central tool for every options trader. It's a grid-like display that shows a list of all available option contracts for a specific underlying asset. For example, let's look at the options chain for a made-up company, Tech Innovations Inc., with the ticker TII, which is currently trading at $150 a share. When you open the options chain, it might look a little overwhelming, but it's organized to give you a clear view of the market. At the very top, see the symbol for the underlying stock, its current price, and some other key information. Below that, the chain is organized by expiration dates. You'll see a list of different dates, and clicking on one will show you all available contracts that expire on that specific day. Once you select an expiration date, you'll see the two sides of the options chain. On the left side, you'll find the call options, and on the right side, you'll find the put options. Each side is a list of all the available strike prices for that expiration date. As we explained in a previous video, the strike price is the predetermined price at which the option holder has the right to buy or sell the underlying asset. For each strike price, the chain will display a row of data, and this is where you'll find all the key information about that specific option contract. The most important columns you'll want to pay attention to are the last price. This shows the price at which the option last traded, which is its premium. For a $155 call on TII, the premium might be $2.50. The bid and the ask, these represent the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. For this same contract, you might see a bid of $2.45 and an ask of $2.55. Volume. This indicates the total number of contracts that have been traded for that strike price and expiration date during the current trading day. A high volume, 4,600, suggests a lot of market activity and interest. Open interest, it shows the total number of open contracts that have not yet been closed out or expired. Open interest for this specific contract could be 14,800. Which gives you a great sense of its overall liquidity and popularity. Implied volatility, IV, this is the market's expectation how much the underlying stock's price will move in the future. IV for this option might be 30%, indicating the market expects some significant movement. As we discussed in the last video, high IV means options are more expensive, while a low IV means they are cheaper. You can use this to your advantage. For example, if a stock's IV is higher than its historical average, options might be overpriced. Learning to read this data is a key step towards making smart trading decisions. Analyzing the volume and open interest, you can gauge market sentiment. By comparing the implied volatility across different strike prices and expiration dates, you can find options that are relatively cheap or expensive. In our next video, we'll dive into the Greeks. We'll start with an overview of delta, gamma, theta and vega, and why understanding these metrics is crucial for managing your risk and understanding how your options positions are likely to behave. Don't forget to like and subscribe so you don't miss the rest of the series. I'll see you then.